What do you make of the China trade data released today? We had weak export numbers, but should we be looking closer at the import numbers? And what does this say about China's domestic recovery and indeed recovery globally?
I think it's quite surprising in the context of the figures we saw out this weekend, which was some very strong industrial production figures, the third month in a row of better than expected industrial production figures. To see export figures which are so soft. Of the two of them, I tend to look at the export figures because they tend to be rather better correlated with corporate profits. And as an equity analyst, that's what I'm more sensitive to. But I think it does suggest the combination of the trade figures and the industrial production figures over the weekend do tend to suggest that the Chinese economy is recovering, but isn't recovering really because of exports outside, and is getting a little bit less sensitive to the rest of the world and a little bit more responsive to or dependent on domestic demand. And I think that's a good thing. That's very much what the government is trying to achieve. In the medium term, that's what we need to see in terms of the Chinese economy. In the very short term, it could lead to some downgrades in terms of the earnings expectations for 2013, however, for the Chinese market. But I think more broadly, the Chinese market is probably at a phase where it's not too sensitive to the earnings figures. It's rather more driven by policy and expectations of how the growth will be 6 to 12 months hence.
Looking beyond China, I see you want to buy Japanese financials at the expense of Chinese financials. What do you see in that cross-asset strategy?
Japanese financials are actually the most sensitive of any Asian sector to an improvement in the European situation. They're the most correlated of any of the geographic industrial sectors to the European stock markets. Over the whole of 2013, we think that the European story is going to improve. The first quarter of 2013 may be a little bit tricky as people start looking ahead to the Italian elections and then the German elections in September. But as people start to think more about banking union and start to think about the political solutions which Europe is putting in place for after these elections, and we do expect to see some very clear steps towards fiscal union over the course of 2013, then European stock markets should outperform. And the best way of making a euro play in terms of correlations with Europe in Asia is via Japanese financials.
We have a political transition in December 16th. We're seeing the yen fall. How now should investors be playing this market?
Well, I think you're absolutely right. Our expectation is that the Japanese yen is going to be weak over the course of 2013. It's moved already up to around 82 against the dollar. It could easily be at 86 by the middle or the third quarter of this coming year. And that's probably part of a medium-term yen re-rating. There have really been two big cycles of the yen over the past 12 years. There's been 2000 to 2007 when the yen was generally weak, and 2007 to mid-2012 when the yen was generally strong. Now we think we're going back into a medium-term period of yen weakness. So that's probably the thing that people have to be most sensitive to if you are long Japanese assets, to be underweight the currency.